I'm Darius McDermott of FundCalibre. I'm fortunate enough today to be joined by Marcus Brookes, who is Elite Rated Manager of Schroder Multi-Manager Diversity and Diversity Tactical funds. Marcus, you've got some interesting things going on in your funds at the moment, and tell us a little bit about them and why you're particularly positioned this way, particularly with respect to inflation.
Sure, okay, yeah. Well, they're all kind of linked together, which is why I think it's right to sort of go through the entire story. If you look at the economic recovery from 2009 and the subsequent market revival, it's really been led by the bond market, which I think would surprise quite a few people. Bonds have been really, really good. But also the type of equity performance that you would expect in a revival, companies with cyclical traits, car companies, airlines, anyone that tends to make more money in an economic expansion, they actually haven't done as well as you'd expect. It's been the higher quality growth type companies, pharmaceuticals, utilities, tobacco stocks and so forth. So the way that we can kind of understand why that growth profile and those sort of shares have done well in a unique manner is to say, well, we think it's because it's got something to do with the growth profile of the economy and the very, very low levels of inflation that have been observed over this entire economic cycle, which may be coming to a close now. It's quite old, actually. So as we've gone through this economic and market environment and observed that the different type of performance is happening, maybe we should start thinking about a different type of portfolio as we enter what could be an inflationary phase. Now, we've seen commodity prices come down enormously, which is one of the reasons we think that inflation's been so low. But oil at $26 a barrel, that's pretty low. How much lower can it go from there? So if anything, commodities may now start adding to the inflation calculation. So we get a little bit of inflation there, a little bit of inflation from wage growth, a little bit of inflation just from good economic growth. And that means that we've got a very different environment to what we've just experienced. And I think it's right to think about a different type of portfolio. So whilst we can see, say, good high-quality growth companies have done well for the first bit, maybe now we're starting to think about value companies, the sort of cyclicals, car companies, and mining companies in particular. So as we start seeing the effects of inflation pick up, maybe we need to think about value. Value tends to be quite risky, though. It tends to be very, very volatile. So the way that we can dampen that risk in our portfolios is just have slightly above average levels of cash just to keep that volatility down.
Thank you very much.
You're welcome.